I'm going to talk a bit about the global political scene, what went right, what's changing, and what to worry about. And I'm talking from the perspective of a long-term investor, active equity fixed income manager with about half of its assets invested outside the United States. And as you know, Capital Group has long been a global investor. In fact, the CI in MSCI stands for Capital International, which first created the index in the 1960s. And I want to start with a little bit of history because I think it's an important perspective. If we go back to the time of the financial crisis, 2007, 2008, and look at what happened after that period, most of the things that the markets were most worried about didn't actually happen. The first G20 meeting, straight after the crisis, was focused on how to prevent protectionism. People thought that trade barriers would be erected. Again, capital controls would be put in place. Basically, we would see a round of competitive currency devaluations, if not a currency war. And basically, people feared the reversal of globalization. In Europe, markets were worried that the Eurozone would fall apart. It made no sense to have countries like Germany and Greece sharing the same currency. How could you have monetary union without fiscal union? We feared either that countries like Greece would have to leave in order to devalue their currencies to get growth going again, or that Germany and the Northern Europeans would push them out, or there was a third option that Germany itself might leave. None of these things have happened 5-6 years later. In the United States, we were worried that banks might need to be nationalized, that is, if the financial system itself didn't really enter a real crisis or collapse. There was a fear of a really serious recession. The budget and debt problems at that time it was feared could create a crisis of confidence in the dollar. And we were on the edges of our seats for years. As each congressional session, we worried about whether there'd be a fiscal cliff and whether the debt ceiling would be raised or the United States would default on its debts. In Japan, we were worried that it would continue the path to very polite decline into comfortable retirement and irrelevance. In China, our fears were sort of schizophrenic. From one extreme, we were worried that its current account surplus was so huge that it would challenge the United States. You recall, it was in Canberra, I think, that Secretary of State Clinton asked Prime Minister, I think he was then Prime Minister still, Kevin Rudd, how do you deal with a country which is a competitor but also your banker? We've been worried that there's a credit bubble and that local government debt will bring down the system. So we worry about it being too weak and we worry about it being too strong. The Middle East, there were serious concerns about the impact of an Israeli or US attack on Iran and what that might mean for stability there, terrorism and oil prices. Now, it's not that we were wrong to worry about these things, and some of them are still in a way on our agendas. But it's worth reminding ourselves of this because the reason that most of these dire things have not come to pass is that governments have actually intervened. They can see these things as well as us. The difficulty is for financial markets is that governments don't look at these problems in the same way, and they don't solve them in the way that we often in the financial markets think they should. So our inclination in financial markets is not to take changes in framework and the policy context adequately into account. Let's take Europe, for example. It would have been much cheaper and much more sensible in some respects just to bail out Greece's debt. It would have been far cheaper and it would have solved Greece's problems much earlier. Also take into account the fact that governments on the whole lack knowledge about how financial markets work, and it's not to be underestimated the degree of resentment that there is even in sort of economic policy elements of governments about the role of financial markets and the way that they tend to make money when things don't go the way that they would like or that the governments would like. In Greece, however, the Europeans decided they were going to take a different track. They wanted to ensure that there were reforms that would make the Greek economy sustainable. They wanted to hold the European Union together. And in this, we in the markets often underestimate the strategic and political factors that are at work here. I don't think I saw for a long time any comment in discussions on Greece in the media about how having Turkey next door, a long-standing threat to Greece as the Greeks see it, playing a very significant factor in the choices that Greece would make about the price it was prepared to pay to stay in the European Union. Likewise, Ms. Merkel didn't want to be the German who, for the third time in history, caused division in Europe. Market reactions to European Council meetings were typical in the markets in the few days before each of these meetings every few months, because people thought there'd be a solution, and then a couple of days afterwards the market collapsed as we realized that actually they hadn't produced a solution that was going to last for more than a few weeks and just sort of dull the immediate edge of the crisis. As long-term investors, we need to look through these periods, these troughs and peaks, and see what the underlying dynamics are and how they will reassert themselves. So here are a couple which I'd like to mention that we need to keep an eye on now. One is the future of globalization. Of course, it didn't reverse at the time of the financial crisis, but its very success has actually changed the picture of the world economy substantially. The global picture of competitiveness has changed, and that will, of course, contribute to slower growth in the world. The period of large additions of cheap labor in China in particular are over. We see wage increases accelerating in China, putting pressure on inflation and increasing the effective exchange rates. And this is true of other emerging markets as well, if not all of them. These developments are actually reflect the other side of something which is very, very attractive to our companies, and that is the growth of a large middle-class market with huge sort of increases in both in daily consumption and in consumer durable goods. China and Japan are a wonderful story of how this competitiveness has changed. In 2000, the similar goods made in Japan would cost 5 to 6 times as much as they would have cost in China. They are now comparable. So 2 decades of deflation in Japan and 5 to 8 years of wage inflation and real exchange rate appreciation have produced a dramatic change in the situation. Likewise, the United States, after a period of dollar depreciation, reducing wages and cheap energy, is now competitive, or at least parts of its economy are competitive in a way that hasn't been for years. In China, the terms of trade are deteriorating, corporate margins are under pressure. So what we've seen is the opening up of the world economy in the 80s and 90s, marrying this new workforce with a much lower and more global interest rate than emerging markets could have managed out of their own resources. Quantitative easing really just prolonged this period with a flood of cheap capital, which doubled into emerging markets since 2008 from $4 to $8 trillion. This presented emerging markets with a choice between depressing their currencies and risking inflation, interest rates, and slowing down growth. Now the writing is on the wall for quantitative easing. Real interest rates have been going up in the US for the past year for US 10 and 30-year bonds. And this will constrain capital quite severely. If you add to that bank deleveraging and renationalizing, especially European banks from Asia, regulatory pressures for banks to increase their capital ratios and to pay more for leverage, liquidity requirements. This is going to make banks a lot more cautious than they have been in the past. You add to that other features of so-called financial repression, like requirements for pension funds to hold certain amounts of particular assets, and the fact that the political default position in most countries is suspicion of banks, and any time there's a problem to return to the regulatory pressures on them. Finally, just 2 or 3 points about a number of countries and areas that I think it's worth keeping an eye on. And in particular, I mentioned Japan. Don't bet against Japan. One of the things that is very interesting about Japan is that the changes in economic policy in Japan are complementary to very important strategic drivers. Japan isn't going to commit collective national suicide. It realizes that it faces a major threat to its independence of political decision-making from China. The pressures are very great. And so you've got a new prime minister with a strong sense of this change in the strategic environment and an understanding that Japan can't compete without having some form of economic revival. In Europe, there are some signs of optimism in some economies, but they're very sporadic, and I personally am very skeptical. It's hard to see growth resuming Eurozone-wide on a sustainable basis unless the debt burden is tackled one way or another and lifted. Europeans will probably try to, and Germany probably won't change its policy greatly after its election. They will try to do this and spin it out in a way which spins out the answer as long as possible and keeps the pressure on the peripheral countries. But for the time being, what's happening is growth is still below the rate at which the debt is growing and the interest rate on the debt. So it's very hard to see an outcome there which doesn't require significant change, and a good outcome there which doesn't require change in policy. On the United States, there's a lot of Sturm und Drang every time the debt ceiling has to be raised and the budget has to be approved. It's now 4 years that we actually haven't had a budget passed in the United States, but we're relying on continuing resolutions. My guess is that this time, like every other, the market will get more and more panicked, but there will be a solution reached, which won't be ideal, but it will be okay because it will keep the budget expenditure down, and it will move the debt to be solved for another day, and that'll leave the US until around 2016. Meanwhile, underneath the surface, there's a lot of discussion going on about how reform can be done, entitlement reform dealt with, and a long-term, more sustainable debt managed. And my guess is that we will get there. The final point about the US is just how important its role is in the world. Just as recent economic developments have shown how crucial the United States and the United States dollar is for the global economy, United States preparedness as the stabilizer of last resort internationally is still crucial. we won't have growth of any sort unless there's some sort of stability in our own region, notably because it's such an important part of the world economy, but also in the Middle East. The big thing that we need to worry about and watch for is the credibility, the US's will to act in this role, its commitment to act in this role, and of course for those of us who are allies of the United States, there will be further expectations of us helping the United States in the future, as it is not so dominant as it once was.
My brief is to tell you about the other parts of the world, the emerging markets and frontier markets. The little focal point that we have here is around the private equity aspects of it, but that's just simply to give you a way of digesting that as investors. So I'll talk a little bit about the macro situation that we're seeing the emerging markets and frontier markets in today and how that's changed, and then talk about how that actually translates into what's relevant for Australian investors, and particularly in the private equity context. And I'll try to do that relatively briefly. So, what I'm trying to lay in front of you today is a nuanced case for the emerging markets as a destination for investments. And it's great to see that 89% of the folks here have thought about increasing their total exposure to global assets. That's a challenge for everyone in their own home market bias in terms of investing. And the fact that you're very outward looking, I think, continues to show how forward-leaning the super system has been in terms of thinking about long-term returns for investors that are actually diversified in a balanced kind of way. But the way to actually think about emerging markets today has got to be different than the way that we thought about it 5 years ago or 10 years ago. And that's because of this. The fundamentals that were sold to folks in the emerging market story were that there was going to be an emerging middle class that was going to be dramatic in size and dramatically expanding, particularly in the emerging markets. It's something that Michael just commented on, and I think is something that is absolutely continues to be clear. There's 800 million middle-class folks in the emerging markets today. That's expected to double. Their purchasing power will increase. The rate of growth will increase. The importance of the economies that have in that part of the world will increase by just total concentration of global GDP. And that process might change in terms of its speed, but not in terms of its directionality. There will be some changes in the shape of that growth, but I think that's the fundamental context in which we actually see the world today. What's different has been the valuations that have been driven by that and the capital flows that have actually driven those valuations. So while the economies themselves are growing and you have GDP per capita increasing, as investors you all know that we can't actually eat GDP. And then the shape of that GDP actually is changing over the next period as well. So while you had in the earlier part of this century, very strong differentials in performance, that performance differential has changed. People have taken advantage of that over the last couple of years, and that's being reset as we think about the shape of the global economy changing in response to what's happening in the post-GFC kind of world. What's happening is a real rebalance of what's going on, and that is the differential in growth fundamentally between emerging markets and developing markets has changed. And that's because some of the fundamental aspects of what has driven that growth have also changed. A lot of the reforms that occurred in the pre-2000 period in a number of economies that established a more friendly investment climate, the rate of urbanization and growth in China in particular, which drove a lot of the demand for commodities globally, which pulled along commodity-driven economies, and also the development of a middle class that actually was employed by those folks. And the rate at which actually had valuations changing in response to this has also changed. And in response to that, the also relative returns between emerging and developing economies has also changed. If I could actually, I know it's a bit of an eye chart here, the point in the tail end of this graph where in about April of 2013, where the two lines start to diverge, the top one being developed markets, the US index, MSCI USA, and MSCI EM being the bottom one, is right about the time when they were starting to have a conversation about quantitative easing tapering in the United States. So we haven't even gotten to the point yet where that actually has changed, but the relationship in terms of return is changing because the perspective that most listed equities investors and fixed income investors have towards how the emerging markets are developing vis-a-vis developed market opportunities has changed dramatically in the last couple of months. And what that really is driven by is a change in the fundamental assumptions of the relationships between economies and the relationships between valuations. So if you rewind the clock back to the 2002 period, or 2002, 2003, which was when they coined the term BRICS. And the idea was that Brazil, Russia, India, China, these emerging economies were going to grow at 8 to 10%, upwards and to the right. And developed economies are growing about 2 to 3%. So that differential between 8%, 7 to 8% in terms of overline headline growth, the move and the creation of this kind of middle-class purchasing power was really what drove a lot of investor interest in these markets. In the context also of a very, very benign interest rate environment, which has driven people to invest looking for higher returns, this caused a huge capital inflow into the emerging markets. That trend has continued even with a shock after the great global financial crisis. We've had this real shift towards thinking about how to actually invest in the emerging. So two things have really altered there. The first is a change in the actual environment itself. A lot of the reforms have kind of played themselves out. The growth in global trade has really increased, and we're getting to the end of some of those structural changes and hitting some of the challenges with regard to that part of the way the markets exist. And the second thing is the relative return profile between emerging markets and the developed markets has changed. In other words, what we've had because of the quantitative easing phenomenon globally has been a strong push on fixed income and other types of returns outside of developed markets, chasing sort of a yield target to actually make it work for actual long-term investment. That's pushed all kinds of asset categories into new levels of valuation. So I think the headline for me in the emerging markets context was in, I think, the March-April timeframe of this year, Rwanda, for the first time issued a US dollar-denominated sovereign piece of debt, $400 million. It was 8 times oversubscribed, and it was priced at 6.875%. So the chase for yield that was driven by the kind of very, very aggressive monetary policy to create the stability environment that has allowed us to kind of recover from the global financial crisis, albeit slowly, had pushed investors so far afield that they were looking at trying to buy bonds by African sovereign nations which had never issued any kind of debt like that before. There's talk now about Tanzania following suit with $1 billion issuance, and this kind of yield chase has pushed folks into asset categories, into types of both equity and debt in different places that they have not been before. Now, what happened in the April-May timeframe is when the US government started to talk about its interest in tapering that quantitative easing, and we started to move into an environment where we didn't have almost an infinite monetary policy, yields, as Michael had talked about, have changed, and expectations that you would actually return to a more normalized environment for fixed income and for equities changed. The relative top-line growth between emerging markets and developed markets has changed, so the expectation that the United States will continue to recover, I think, has increased. The glimmerings of a potential recovery in parts of Europe have increased, and at the same time, the headline growth in countries like Brazil, countries like China, countries like India, which just touched 4.4% growth in the last quarter, have really fallen off. So that difference that used to be the 10 versus 2 is now more like 2.5 to 3 in the United States, bouncing just in recovery levels in Europe, attempting to recover in Japan, versus maybe 4 to 6, 6 to 8, somewhere in there in the developing markets. And also this change in the actual way capital flows are actually shifting around in the markets themselves. So that sets us up for a very interesting environment going forward. It's one where there have been substantial outflows of fast money capital out of listed equities markets in the emerging markets, with the impact on currencies that we've seen just in the last couple of months. Strong decreases and declines in the valuation of the South African rand, the Brazilian real, record lows in terms of valuation of the Indian rupee, and all the recurrent issues that you have with current account deficits in those markets. At the same time, those capital has come back into more real risk assets in the United States in particular. US equities have come up a lot. Relative return, I think, is now exploring areas of Central Eastern Europe. I think we'll hear some more commentary about that. But there's been about over $8 billion of capital has come out of the emerging markets context, in the listed equities context itself. Now, that's the listed equity story, and I think the outlook will be one of increasing volatility over the next probably 2 to 4 quarters, as we actually see announcements of quantitative easing occurring in the a tapering of that occurring in the United States. The real effect of that reduction in purchasing, which is not, again, an increase in underlying base rates in the United States, but a show of reduction of this kind of support by the governments, which has supported these markets for a long period of time. I expect to see a lot more volatility in the emerging market story as people start to reorient themselves towards the United States, towards Europe, towards other types of asset categories, and a lot of the money that chased yield, things like Rwandan debt purchasers. Rwandan debt today is trading about 8.5%, for example, as well as equities in these markets have come down as people have rebalanced their portfolios back into developed markets. So that's the developed markets context and the fixed income context in listed capital markets that are out there. The story is a little bit different when it comes to the private equity landscape, which I think is something that we should all keep in mind as we think about ourselves as longer term investors in particular. Part of the challenge with listed equities in the fixed income markets in emerging markets is that, unlike the United States and Europe and other developed countries, the markets are relatively thinly traded and they're highly concentrated. So while one of the big attractions to the emerging market story has been the push towards a growing consumer class, a growing middle class, and growing purchasing power, a lot of the exposure to those markets can't be had in the listed equities markets. They're heavily concentrated in financial services and in the natural resource sector. So for example, if we look at a kind of a standard or sample private equity portfolio, like one we've constructed, you can get 5% exposure in healthcare, 15% exposure in information technology, next generation kind of business services. The healthcare story is one where it's the only asset or sort of sector in the world that actually increases at a rate faster than GDP in every country in the world. But if you look at the listed equities markets, you can get fractional exposure to it in any of the listed markets themselves. And the same thing is true for some of these other types of sectors, which you think might be attractive to the headline challenges or the headline opportunities, I think, in the emerging markets. So private equity itself, in addition to being a less volatile asset class, is also exposed differently to the emerging markets context than the volatility you're going to see in listed equities overall, and especially on the fixed income side. The next thing is that private equity in the emerging markets is different than private equity in developed markets. It's less leveraged, valuations are lower, there's more of a maturing market for this kind of activity, so it's becoming much more digestible from an environment, social, and governance standpoint. And so the opportunity set continues to evolve in a way that actually becomes more easily investable and with a lower kind of risk profile than you'd seen in other kinds of private equity markets around the world. In addition, I think that you're going to see the maturation of the private equity industry in emerging markets as you've seen it done in the developed world. We're going to have secondary activity occurring that should give people an opportunity to take advantage of differences in valuation and rebalancing of existing portfolios of assets. And also a focus on thinking through a more standardized way of approaching things from a governance standpoint and from a valuation standpoint. So I realize that Wayne Gretzky may not be as famous here in Australia as he is in North America, especially Canada and the United States, but he is a legendary hockey player. And so the Gretzky challenge comes from one of the phrases that he used once when he was asked how to be a great hockey player, and he said, "You have to skate to where the puck is going, not to where the puck is." And so the question is, what is going to happen in emerging markets over the next period here? And how do we actually position ourselves to think about it in a way that actually takes advantage of the potential changes that are going to occur? So I just have a couple of thoughts to share with you here before I wrap up quickly and we kind of move on to how investors are reacting generally. The first is, the only constant is change. So the story about emerging markets was that it was going to grow uniformly up and to the right 10% per year forever, compared to 2 to 3% in developed markets, was never going to be true forever, just like none of these stories that go up and to the right forever are actually true. What is going to change over the period is the shape of that kind of growth and the relative position of those economies versus developed markets. The US continues to recover. You're going to see glimmerings of this in Europe. The underlying story about a transition to a growing middle class with purchasing power and a domestic economy that has been talked about for the last decade in emerging markets will continue, but the rate at which it's going to change and how it's going to go through cycles will have to be recognized in the context of how we're seeing these things. You're also going to see this removal of what is really clearly a historic and unprecedented amount of intervention in the monetary markets by central bankers in developed markets. The second point is that this change in the opportunity set will offer all kinds of new potential opportunities as well. The labor rates that have increased in China that Michael referred to have not actually impacted other markets in Southeast Asia, for example. You're seeing a manufacturing shift into places like Indonesia and Vietnam. You're seeing an increased recovery of investment activity in places like Mexico, which is finally getting the advantage back on the manufacturing side after competing unsuccessfully on a labor wage basis versus China. And so as this entire headline economy shift actually changes, the opportunity set to invest against the new manufacturing bases, the new consumer classes in these different markets will also shift around. The second thing is that the change in valuations that we've seen over the last period should also offer a very interesting opportunity set in terms of getting into these markets at valuation levels that are going to be more attractive. So if you look at Indonesia, for example, they've had 6% plus growth for the last 8 or 9 years. Since the 97 crisis, they've now dipped back down below 6%. Valuations have been impacted in India, in China, in Brazil, and are now pushing them back towards levels which look more like the 2008 kind of standard in valuations in a relative basis between developed markets and developing markets. That's in listed equities, which are going to be highly volatile, but entry market multiple valuations on private transactions should also be similar. The last two things are that change will change again, that this rebalancing of the relationship between emerging markets economies and developed economies will also shift. In a world where the US returns to 3% growth and Europe starts growing at all, and Japan actually pulls out, those goods and services will have to be manufactured somewhere. With a rebalanced set of currency relationships between emerging markets and developed markets, that manufacturing and that kind of activity on an increased competitive basis is likely to flow back through into the emerging markets as well. So I think if you remember back to the period of the global financial crisis, there was a lot of discussion of decoupling, where the emerging markets are going to miss this entire reset of the global economy, which obviously didn't happen. They actually were impacted as a result of this as well. There should be recoupling both on the downside and on the upside. So as developed markets return to growth, there has been a reshuffle of the relative attractiveness and the valuations of those markets, but that should start to drag along the rest of the world economy as well. And finally, the only thing to leave you with at the very end is the angel's in the details here. You can't eat global GDP, and global macro is going to affect these things, especially on currency valuations, and the amount of currency risk, I think, and volatility we should expect should go up over the period. But by focusing on targeted sets of investments or targeted sectors and working with the right partners, I think there's still lots of opportunity. So I'll leave you with this last slide, which is sort of as an outline, a quick tour of where we think the opportunities really are. In Brazil, I think it's a continued focus on consumer, the consumer and retail market, as well as a move towards the secondary cities. I think in India, it'll be a secondaries opportunity as valuations really come down and a reset in the valuation expectations of folks in that market. China will shift into a differentiated growth phase where there'll be consolidation of some heavy capital intensive industries, the emergence of what is really a spectacularly different internet economy, as well as continued growth in the middle class in certain secondary and tertiary cities. And in Russia, I think just an ongoing continued transition away from a natural resource centric economy. I'd also say that there's great opportunities that will be created in other markets. I think Africa itself will emerge or continue to emerge as an area for growth, quite differentiated from the rest of the world. And I think you're going to see some of the shift that's occurring and the decreased competitiveness in China from a cost basis into more opportunity in Southeast Asia, which I think should be something that Australians should be able to take advantage of. So thanks very much. I hope that's a great tour of kind of where we are. I think the opportunity set is there. The emerging market story is never going to be over. It's one that will just change its shape and its relative position versus developed. And if you pay attention to the details, I think that there's great opportunity out there. Thank you.
Good morning, and it is nice to be here in Australia. My presentation is slightly looking through the telescope in the opposite way because what I bring, if I bring any insights, it comes from having had the privilege of sitting at investment committee meetings in various parts of the world and talking to long-term investors in various parts of the world, and synthesize. And this presentation tries to synthesize, certainly for main markets, the sort of thinking that's going on in the UK, in Europe, and in North American institutional investment minds, and hopefully it'll give you some idea of where the flows of money may be going. The first slide had a huge amount of problem with compliance because they said, well, what date do these relate to? And I said, well, all sorts of dates, which they found. So I have to say, don't take any notice of them. But the purpose of this slide was just to sort of try and illustrate the sort of environment facing that people in Europe, people in the States are looking at hugely low interest rates on cash, definitely negative return. Every pound or dollar in their bank account is going to be shrinking in real terms every year for the foreseeable future. Bonds the same, index-linked gilts very highly priced, and the only thing that looks at all value is equities. So with that in mind, and then they don't have the good fortune to listen usually to people as intelligent as my colleagues on the panel, but they do have experts who come to talk to them, and they form their views. And I think the view is actually not dissimilar from what's been expressed by my colleagues, that on Europe there is a feeling that the can is still being kicked down the road, none of the problems have been solved, and there is great uncertainty as to whether the very binary decision, will the euro survive or won't it survive? No one wants to put a probability on either event, and in general that just means a nervousness about Europe and avoidance of Europe. Generally a feeling that the US is back on the road to recovery. There may be some long-term problems in the US, but not major, and if you'll indulge me, I know the UK is a small place, but it's a big place to me. I think a sort of feeling the UK is halfway between Europe and the US, which is not quite geographically correct, but it's roughly right. In terms of the rest of the world, I think we're very positive about you and Asia. Japan, we do think it's going to be volatile. Japan in 1989 was 50%, just about 50% of the world market cap. And it was the time when I think the Imperial Palace in Tokyo was worth more than California. Clearly that was a bubble, but on the other hand, it's now well less than 10% of the world. And I think there's a talk going on in boards is have we ignored Japan for too long? And it was interesting that was mentioned by the first speaker. So Japan is something that no one's sort of upping their investment to really, but people are wondering whether they should look at it. And then emerging markets, I think the conversations that are going on at the minute are to do with, should we think of BRICS as things that hold together, or are BRICS falling apart? And are some of is the C in the BRICS somewhere you should go, but perhaps the B somewhere you shouldn't? So discussions about selectivity in emerging markets are the conversations that are going on. The big elephant in the room is inflation, particularly, perhaps for any investor, because I guess it's very few investors who don't want their wealth to grow in real terms. And there is a feeling that almost a primitive feeling, and you can find economists who'll say otherwise, but a feeling that with all the money that's being pumped into the system, at some time down the road there's going to be inflation. And most investors want real returns. But then when they look around, of course, when everyone wants some insurance, the insurance is high, and TIPS, index-linked gilts, are massively expensive. And so there's a looking around at other possible investments. Infrastructure has been on agendas for many years, but previously it was very much sort of private equity type infrastructure and private equity type returns. And now investors are going out and saying, can we get the next tier up where our return is perhaps lower but more linked to inflation, and then looking at other asset classes. So inflation is a worry, but no one knows how to solve it. The next one, if you'll indulge me with a little story which is true, and I should preface my remarks in this day and age, say that the purpose of this story is not to make some gender point, but you could substitute it. But several years ago, I'd agreed to go down to Devon with my wife to see her mother. And then on the week, at the start of that week, I was offered a ticket to see England play, I think it was Wales, at rugby. And immediately I had somewhat of a dilemma. I knew which I was going to enjoy most, but I knew where the greatest risk lay. And that's really like the discussion with equities, that everyone knows or thinks they know which they're going to enjoy most. In fact, watching England rugby at that time wasn't necessarily that enjoyable, but which is invest in equities. But they also know that that's where the greatest risk is, because the actuary, the accountant, the regulator, whatever it is, whether insurance company, pension plan, is telling them that they should invest in bonds to match their liabilities. And the sort of discussions going on, and really why I introduced the story, you soon come back to four alternatives. Either you cave in and then go shopping in the afternoon when you get there, which is the buy bonds route. Or you go and watch television, which is what a lot of people are doing, which is go into bonds but buy corporate bonds or buy high yield bonds and get some of the enjoyment but take out a lot of the risk. The next one, and actually that was what I did. The next one, which I contemplated quite seriously, was going to the match, not going for a drink afterwards, and telling my wife what a sacrifice I'd made. And that was quite high on the list. And that's the one which quite a lot are contemplating, which is buy the equities, but buy low volatility equities, buy some protection, get most of the enjoyment, but give up some of the enjoyment. Of course, what you could do is just go to the match and go drinking afterwards. But my sense with long-term investors, there's very few, and there was a talk about a great rotation. It hasn't happened. And that's not because people wouldn't want it, but it's just this mark-to-market regulation. So just briefly, in terms of getting more out of equities or going to the match and then avoiding the drink afterwards, what a lot of the discussion has gone on to is how can we get more out of our equities? And it's not the purpose of this conversation to talk about smart beta and all the other things, but this table, which is courtesy of the BT Pension Fund, just kind of shows the sort of premia embedded in equities and how if you bias towards those premia, certainly historically you can improve return. Changing tack a little, a lot of investors do want income, and one of the other implications of the world that surrounds them is that they haven't got the income that they want. Cash flow is important. And here perhaps is what investors in the States and the UK, and I don't know where you are, perceive as some genuine, not a free lunch, but real value, because there is, and this is probably the only investment area I can think of at the minute where there are as many willing sellers as willing buyers, and that's in the area of debt, because the banks, particularly in Europe, are trying to shrink their balance sheets. They're stopping lending, well, not stopping lending, but lending much less. And traditional areas of bank lending, like real estate loans, unquoted loans to corporates, are no longer being supported. And there are reasonable yields to be had by investing in these areas, although, of course, you have other risks like liquidity and so forth, and a lot of conversation going on around boardrooms about alternative forms of debt. Most had already gone into high yield or emerging market debt, again, search for income driving them away from conventional bonds. That's still happening, but I think there's a feeling around tables that there's so much money gone into those areas that the, not the free lunch, but the going further is starting to, the risk-return equation is turning against them. Finally, a phenomenon that I think is about the only investment thing that ever started in the UK, which probably doesn't augur well, which is the Diversified Growth Fund. What is it? I think that there was and it was driven out of the pension funds. It's now starting to get some traction in Europe, the US, and I think even in Australia there may be one or two investors in it. And the aim was, can we put together a mix of assets which will give us an equity-like return with much lower volatility, much lower downside risk? You know, the new alternative to my dilemma about rugby and so forth. And how does it work? It's just by diversification. And there's no common approach. There are a lot of managers out there offering this. And my only worry is about the does it work? And the cynic in me says that when you go through the financial crisis, and there were some of these around before the financial crisis, statistically, some of them are going to do well and some of them are going to do badly. But what we remember afterwards is the ones that did well because their salespeople publicised them, and the ones that did badly we forget about because no salesman's talking about them. And certainly the idea grew in the UK that these things worked. And as a consequence, they've had a whole lot of money going into them. Whether they'll work in the next crisis is, of course, the key question. There's no point having something that fought yesterday's battles. So my final thoughts, the GFC has obviously had a great influence on people's thinking around boards. It's 5 years ago, but it's still in people's minds. And the cynic, skeptic, whatever in me worries that investors are doing what they very often do, is look in the rearview mirror and devise strategies which would be great if we had another financial crisis exactly like the last financial crisis, but probably the one thing we won't have is something like that. Or have we this time round learned from experience? And it's really not for me to judge, but it's something that worries me. And along those lines, are we just investing in those things that worked in the financial crisis, or are we actually being more selective in our investment? I don't know. I think a personal view, if I'm allowed one personal view in this, is that the financial crisis wasn't a black swan event, it was just an earthquake. We've had earthquakes before. No earthquake is like the last one, but they happen, and there's aftershocks as well, as we saw. And finally, just an observation, for my generation, what happens in the next 10 years is big news, because, as you know, if you get a 10% return on £100, you get £10. If you get a 10% return on £1, you get 10 pence. So it's much better to get your good returns when you've got a lot of money. And the baby boomers' wealth in the next decade is at its peak, and they really need to make a lot of money. Thank you.